There are 5 government forms sitting online right now, completely free, that the average American born before 1971 has never filed in their entire life. Every single one of them could put real money back in your pocket before this year is out. Before I show you the first one, I need to clear up the biggest misunderstanding, because it is the reason most people watch 2 minutes of a video like this and click away. Some assume this is only for seniors who are struggling financially. If you are comfortable, you tune out. Others assume it is some complicated wealth strategy for people with big portfolios. If you are living mostly on Social Security, you tune out too. Both assumptions are wrong. This list is for every person born before 1971. Whether your entire income is a Social Security check, or you have a pension, savings, and a paid-off home, there is real money sitting in these 5 forms with your name already on it. Here is why almost nobody knows about them. The IRS does not advertise tax savings. The Social Security Administration does not call to tell you that you are overpaying. Your tax preparer is not paid extra to file a form you could technically complete yourself in 20 minutes. The system does not owe you a phone call. It only owes you the form, sitting on a government website, waiting for someone to find it. I am going to walk you through all 5, in plain English, with the exact form number, the exact website, and a real example for each one, so you understand exactly how it works. Stay until the end, because form number 5 is the one almost nobody has heard of, and it has the highest dollar impact of anything on this list. I am going to walk you through a real couple in Arizona who recovered more than $5,000 in a single year because of that one form alone. This video is educational information, not personalized tax or legal advice. Every number I give you is verified directly from irs.gov, ssa.gov, or cms.gov. Always confirm your specific situation with a licensed CPA or enrolled agent before taking action. Let's get into it. Form number 1 is the most commonly ignored form in the entire IRS system, and it is the one that puts cash back into your monthly check the fastest, not in April, the very next month. It is called Form W-4P, and it is free at irs.gov. It controls how much federal tax gets withheld from your pension, annuity, or IRA distributions every month. Here is the problem it solves. When most pension programs and IRA custodians set up your monthly distribution, they apply a default withholding rate. That default is almost always higher than what you actually owe, because it does not account for your specific deductions, including the additional standard deduction available to people 65 and older. Picture a retiree named Harold, 66 years old, single, living in Georgia, with a $38,000 annual pension. His custodian was automatically withholding 10%, which comes to $3,800 a year. But because Harold is over 65 and qualifies for the additional senior standard deduction, his actual federal tax liability on that pension is closer to $1,400. That is $2,400 a year Harold was loaning to the government for free. $200 a month that should have been sitting in his account, not waiting at the IRS until tax season. Form W-4P fixes this. Download it from irs.gov, complete the withholding worksheet, and submit it to your pension administrator or IRA custodian. The adjustment takes effect the next month, not next year, the next month. Form number 2 is for anyone collecting Social Security, and it decides whether the government holds onto your money all year and hands it back as a refund, or whether the correct amount lands in your account every single month. Here is something most people do not know. Social Security payments arrive with 0 federal tax withheld by default. Not 5%, 0. For some people, that is exactly right, because their income is low enough that none of their Social Security is taxable. But for millions of people whose Social Security is partially taxable, that 0 withholding creates a painful surprise every April, sometimes with an underpayment penalty attached. Form W-4V lets you choose your own withholding rate from 4 options: 7%, 10%, 12%, or 22%. You pick the one closest to what you actually owe. This cuts both ways, and I want you to hear both directions. Some people are underwithheld and get hit with a surprise bill. Others chose a high rate years ago when their income was higher and are now significantly overpaying. Consider a couple, Dorothy and her husband, both 70, with a combined Social Security benefit of $34,000 a year. Her husband set up 22% withholding years ago when their income was higher. Today, their actual tax rate on that income is closer to 9%. They have been overpaying by roughly $2,200 a year, more than $180 a month that should have been paying for groceries and prescriptions instead of sitting at the IRS. A new Form W-4V submitted to the Social Security Administration fixes it. You can file it online through your My Social Security account at ssa.gov, by mail, or in person at your local office. 2 of these 5 forms exist specifically for people 65 and older, not for general taxpayers, for you. Form number 3 is the first of those 2. It is called Form 1040-SR, and the IRS created it specifically for taxpayers 65 and older. Millions of people in this age group still file the standard 1040 every year, completely unaware that a version built for their exact situation exists. The larger print matters for practical reasons, but that is not the important part. What matters is the structure. The 1040-SR has a dedicated section for calculating the additional standard deduction for people 65 and older. It has a cleaner layout for reporting Social Security and pension income, the 2 most common income sources at this stage of life. And it includes built-in sections for senior-specific deductions that standard tax software does not always flag automatically on the regular form. Here is the action step. If you use a CPA or tax preparer, ask them one direct question before you sign your return. Are you filing my return on Form 1040-SR? If the answer is no, ask why not. If they cannot give you a specific reason, that conversation deserves a follow-up. If you file your own taxes through software, look for the Senior Return option or confirm your age in the Profile section so the software routes you correctly. Form number 4 is the one that prevents you from being taxed twice on the exact same dollar, and it is quietly costing retirees with IRAs tens of thousands of dollars, not because of anything illegal, just because a number was never tracked. Here is the situation. Most IRA contributions are tax deductible. You contribute, it lowers your taxable income that year, and you pay tax when you withdraw later. Straightforward. But some people, particularly in years when their income was above the deductibility limit, made non-deductible contributions, after-tax money going into the IRA, money they had already paid income tax on once. If that after-tax amount, called your basis, was never documented, the IRS treats every dollar that eventually comes out as fully taxable. You pay income tax on it a second time. Consider Robert, who made $45,000 in non-deductible IRA contributions over his working years. Neither he nor his accountant consistently filed the form that documents this. Now, at 68, taking required distributions, his IRA custodian reports the full amount as taxable income because there is no basis on file. He is being taxed on $45,000 he already paid tax on once. At a 22% rate, that is $9,900 in taxes he never should have owed. Form 8606 documents your IRA basis. You file it with your tax return for any year you make a non-deductible contribution. If you have made past contributions without filing it, amended returns can establish that basis retroactively. This form is also essential if you have ever done or plan to do a backdoor Roth conversion, because without it, the IRS has no record that your original contribution was already taxed. If you have ever contributed to a traditional IRA and are not certain every contribution was deductible, this is worth a direct conversation with your CPA. Now the form I told you about at the beginning, the one almost nobody knows exists. And to understand why it matters so much, you need to understand something called IRMAA first. IRMAA stands for Income-Related Monthly Adjustment Amount. It is a Medicare surcharge added on top of your regular Part B premium when your income exceeds certain thresholds. Here's how it works in 2026. The standard Part B premium is $202.90 a month. But if your income from 2 years ago, specifically your 2024 tax return, exceeded certain levels, Medicare is charging you significantly more than that right now. For single filers, surcharges begin once modified adjusted gross income passes $106,000. The first tier adds roughly $74 a month. Higher tiers climb well beyond that, and for married couples, both income thresholds and the surcharges apply per person on Medicare. Here's the trap that catches retirees specifically, and almost nobody figures it out unless someone explains it directly. Medicare does not look at your current income. It looks at your income from 2 years ago. So if you retired partway through 2024 and your income that year was elevated because you worked the first several months, sold a business, took a large IRA distribution, or received a pension payout, Medicare used that elevated 2024 figure to set your 2026 premium, even though your income dropped dramatically the moment you retired, even though you are now living on Social Security and a modest pension that is a fraction of what you earned that year. You are paying a surcharge based on income you no longer have and will never have again. The Social Security Administration built a specific correction directly into the system for exactly this situation. It is Form SSA 44, a life-changing event appeal. It tells Social Security to use your current income instead of the 2-year-old figure that no longer reflects your reality. There are 8 qualifying life-changing events: marriage, divorce or annulment, death of a spouse, work stoppage, meaning retirement, which is the one that applies to most people watching this, a reduction in work hours or income, loss of income-producing property, loss of pension income, and receipt of an employer settlement that temporarily inflated a prior year's reported income. Now let me walk you through the real scenario I promised. Frank and Carol, both 67, from Arizona. Frank retired from his engineering job in June 2024. Carol retired from her school district position in July 2024. For the months they worked that year before retiring, their combined income was elevated. Frank's modified adjusted gross income for 2024 came in at $138,000. Carol's at $122,000. Because Medicare used that 2024 income to calculate their 2026 premiums, both of them were hit with IRMAA surcharges. Frank landed in a higher tier, adding more than $250 to his monthly Part B premium. Carol landed in the first tier, adding around $74 to hers. Together, they were paying over $300 a month in combined surcharges. Their actual 2026 income was $52,000 combined, Social Security for both of them, plus Carol's small pension. They were paying premium surcharges based on income they had not earned in nearly 2 years and would never earn again. Frank filed Form SSA 44, checking the work stoppage box and documenting his projected 2026 income. Carol filed the same form for her own account. The Social Security Administration reviewed both appeals. Both premiums dropped back to the standard rate. Their combined monthly savings came to more than $300. Annualized, that is well over $3,600 in premium savings for the year. Because they filed early, they also recovered surcharges already paid going back to January. Total savings for the year exceeded $5,000 for the couple combined. 1 form each. Available free at ssa.gov. About 20 minutes to complete per person. Form SSA 44 is available at ssa.gov. You can submit it online through your My Social Security account, mail it to your local office, bring it in person, or call 1-800-772-1213 to request it by phone. Once approved, the correction typically takes effect within 1 to 2 billing cycles. Here is the priority order if you are only going to act on one thing this week. If you are currently paying an IRMAA surcharge and you have retired, reduced your income, or had any qualifying life event recently, start with Form SSA 44. The dollar impact is highest and the correction takes effect fastest. If you receive monthly pension or IRA distributions and suspect you are withholding more than you owe, Form W-4P at irs.gov is your next step. If you collect Social Security and are not confident your withholding matches your actual tax situation, Form W-4V at ssa.gov is third. Then confirm with your tax preparer that your return is being filed on Form 1040-SR, not the standard 1040. And if there is any history of non-deductible IRA contributions in your past, bring up Form 8606 with your CPA in that same conversation. Every one of these forms already exists. The IRS and the Social Security Administration already accept them. The money is already legally yours. Nobody mails you a check for the form you did not file. Nobody calls to tell you that you are overpaying. The system is built so that the money stays exactly where it is unless you stand up and ask for it back. Send this to one person in your life who was born before 1971, a parent, a neighbor, a friend who just retired. The odds are very high that they are missing at least one of these 5 forms right now, and that one share from you could be worth thousands of dollars to them. Subscribe and turn on notifications because IRMA brackets, withholding rules, and senior tax provisions get updated regularly, and I will walk you through every change here in plain English the moment it happens. Drop a comment and tell me which of these 5 forms you had never heard of before today. Or if you have already filed one and it worked, tell me how much it saved you. I read every comment and it helps the next person who finds this video. You worked for decades. You saved. You paid in. These forms exist specifically for people like you, sitting on government websites right now, waiting for someone to ask. Nobody is going to call you about it. Now you know exactly where to start.